Thank you for joining me. I'm Alex, and I want to talk about Aflac today. So Aflac is another one of those stocks that really shouldn't be affected too much by the current situation, and in fact, they seem to be affected in more of a positive way because people not driving means people not causing accidents, and they still get paid. So obviously, more people losing their jobs might mean less people getting insurance, but overall, for now, it seems to have had a net positive effect on car insurance people. Not home insurance people per se, but obviously, just talking about the car sector, it's a net positive effect. So Aflac does insurance, as I kind of implied. And they are one of the biggest insurance companies in the US, and they are also on the Dividend Aristocrats. So they have increased their dividends for at least 25 years in a row. And I think that that's the kind of stability that we're looking for right now. So current price is $36.26, which gives them a market cap of just over $26 billion. Dividend yield is just over 3% with a payout ratio of 27%. Pretty amazing payout ratio considering the dividend. As you can see, they could afford to pay over 10% without actually cutting into their balance sheet. Revenue $22.2 billion, slightly up. Earnings $3.3 billion, also slightly up, and that gives them PE of 9 and a forward PE of 8. Now, disclaimer for the forward PE, that's an estimate from the earnings and does not necessarily apply right now. There's a lot of uncertainty going on, but as I said, they've raised their dividends 25 years in a row, and obviously, the payout ratio leaves a lot of room for things to go a bit south without ever affecting their dividends. And obviously, the current situation is not going to go on forever. So they should have enough money to keep paying the dividend and maybe increasing the dividend all throughout the situation, and then go back to business as normal after everything is resolved. Total assets, $153 billion, up slightly. Total liabilities, $124 billion, also up slightly. Net positive there, which gives them total stockholders' equity of $29 billion. So, obviously, banking and insurance have fairly balanced balance sheets, so that's not really a hugely bad thing here. Normally, you would like to see a higher ratio of assets to liabilities, but again, not a bad thing. Almost $30 billion in stockholders' equity, definitely not a bad thing. Forward PE being lower than the current PE, definitely not a bad thing. Revenue growing, earnings growing, dividend growing, everything is going the right way. So obviously for a growth investor, this is definitely not the stock for you. Unless you want to get out of growth investing, which I don't think the current situation is the situation to get out of that. But if you're looking for some stability, this might be a pretty nice stock to look into. For a value investor, as I said, balance sheets are a problem, but overall, I think that this is a very solid buy for a value investor as well. And for a dividend investor, obviously, there are better dividends out there, but there are not too many consistent dividend payers with a very long history of paying the dividend, with a low payout ratio, with a very safe business model, with safety of principal almost guaranteed. So overall, I would say that this is a very good candidate for a dividend investor as well. And so I've actually been buying this stock, and considering the PE that they're currently at, I'm going to continue buying this stock. And I really like it for the dividend and the dividend growth. That's it from me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.